All right, hey everybody, welcome back to this is episode 13 of the Growth Factor, and I thought we would do something a little bit different. We're starting to see some real movement, and opportunity is starting to present itself in the real estate space. In differing, as we've talked about, as I've talked about before, this market is a little bit different than the reset of the '08 or '07, '08 subprime crisis. That being said, opportunities are starting to present themselves. We're starting to see investor capital move pretty significantly again. So we're, the smart investors, the savvy investors, the institutional investors that are moving capital have started moving capital again. It's created an opportunity for us to open up a new position in one of our funds. Our executive preferred program. And so as most of you know that have invested with us, we've got a number of different levels in each fund depending on what you come in at. And so, we've got institutionals moving money again, and it's created some opportunity for us. So I thought we would take a little bit of a different approach today. I've got Managing Director Brian Robb on with us again. And I'm going to let Brian you give a high level overview of the market, and then let's position this as if you're a prospect, potential investor looking to place capital in real estate today. We've had a significant upflow and uptick in our lead flow for investors coming in to place capital with us. So we've started the year off and significantly increased our investor base and capital base. And so, take the position as if you're one of those investors. You're either new to the marketplace, or maybe you have placed some private investment real estate before, but you're looking for some operators or an operator to place capital with and partner with right now. But taking into consideration everything that's gone on for the last few years and the major problems we've seen operators, investors up and just leave the country and walk away from assets and fold in the doors and the cards. We've seen some operators use this time period to reset and really add to their foundation and build as we have. And no operator has scathed through this or coasted through this unscathed, but we've seen some operators come out on this backside flourishing from it, and some having shut the doors and this has been the end to them. And so I think we had a foundation in place. We had a plan in place that has allowed us to weather this storm, not completely untouched, but definitely come out on the backside stronger. So maybe take that position and let's go from there. So give us a broad overview on the market first.
Yeah, thanks, Ty. Great to be here again this morning. It has no doubt been a challenging past couple of years in the market, but as we like to say, for investors, it's really important to have a long-term view of real estate, no different than if you invest in public equities. I would say the environment overall for 2026 still remains cautious. Interest rates are still elevated. We've seen some relief. We need to see some more relief, but there is a significant amount of debt that is approaching maturity, and as a result, refinancing continues to remain somewhat challenging. And capital structures really that were put in place several years ago was done during a different environment. Interest rates were lower. Refinancing today may require some additional equity or even some creative capital stack structures in order to make it work. We've talked about this multiple times on prior episodes, but with the last big equity market correction, I'd say that was the dot-com bust. If you invested $100 in, I think this was August or September of 2000, that would have been worth $53. It took a good almost 7.5 years to get back just to your initial $100 investment. More recently, if we go back to February of 2020, the S&P dropped about 34%. So when that happened, long-term investors in equity markets didn't necessarily pull out of the S&P. If they were smart, as we all know, they invested more when the market was significantly devalued. So we have that on one side of the table. The other side of the table is foreclosed property holdings in the U.S. by banks grew, as of about 6 months ago, grew by about 30% annually. regional banks, I think, were really particularly hardest hit. And when you think about today's commercial real estate market, the question really, Ty, isn't whether distress exists, it's where it's hiding. I think, the biggest significant concentration of distress has really quietly been building on a lot of balance sheets for these banks. And when we see this happen, the banks really have three options when they are carrying distressed assets. One is they can sell the note, which is going to clear up their balance sheet. As we all know, that usually is going to require some sort of steep write down. They can operate the asset. Banks are banks; they're not commercial real estate operators, so that's not necessarily an optimal solution. Or they can bring in a capital partner. We typically see option number one is the preferred option in the marketplace. So Ty, taking on the role as an investor, how do you see this environment as an opportunity for operators like Lassiter Capital, and how could that benefit someone like myself as a potential investor?
Yeah, well, we're starting to see, because of a number of the reasons that you just named, through some opportunities in the marketplace again. We've, as I mentioned a minute ago, we've had operators that couldn't face the writing on the wall, and they just up and left, or they're looking to get out of deals that they're in, and just walk away and be done. They don't have what it takes, to make it through it. They don't have liquidity. They don't have access to capital, and so their capital pool is dried up. And what I say oftentimes is how you change is how you succeed, is something that one of my business coaches taught me a long time ago. And so you've got to be able to pivot, and many people haven't pivoted through this crisis. And so you've got operators that don't have the liquidity needed for assets. And so that's given us an opportunity to step in and bring in our capital sources, and start looking at some deals on the marketplace right now, or really deals that are not even hitting the marketplace, that we've had a number of lenders reach out to us and say, hey, look, I've got this deal, this operator needs out. They don't have the capital sources, and so here's a deal that you can step into for the debt, or in many cases, that's how the conversation starts out. But that debt number is negotiable, very negotiable. Let's say that the lender has an asset that operator paid $28 million for, and there's a $20 million loan on the asset, and that asset has been undercapitalized for the last 2 years, and it's gone backwards. And we've had some assets like that in a fund that we couldn't bring in additional capital into that fund, but we could open a different fund and bring capital into. And so the asset's gone backwards, and so it may be worth $20 or $22 million now, and there's a $20 million loan on it, but it's setting at low occupancy, and or a lot of deferred maintenance needs to be done, because all the cash flow has been going to try and cover debt service for the time being, and not keep up with maintenance. And so that gives us the opportunity to step in, and first we got to have the liquidity to put capital expenditures into the asset, fix the units, whatever the maintenance needs are. We've got to address that. But a lender is wanting to get out as best as possible, and so they're looking at that $20 million note that they have that's unperforming, and oftentimes they're looking at $14-15 million. In one circumstance, we had a $21 million loan, and the lender was looking for a $14 million payoff. And in another instance, we've seen $17-18 million loan with $14 million payoff. And so those loans become negotiable. So that buys you additional equity. And I always talk about, those four keys to wealth as it pertains to investing. And number one is equity. Getting an asset at a discount. Well, how do you go about doing that? And so there's a number of ways to do that, but one of those ways may be negotiating with the lender for a DPO on a loan, and that lender to stay in. You come in as the savior on the asset with some new capital. You let the lender know, hey, we can take care of the value add that's needed. Here's what we think the property can get to, but we're not going to take over for a loan that is at 100% of face value. We're going to negotiate that down to 75% of face value. And so we immediately get 25% equity there. And then, we're looking for those markets that have appreciation. And so once we've stepped in, we've gotten that DPO handled, We've brought in the equity needed to run value add to the asset. Then we can start addressing what needs to be done to get to positive cash flow. And then obviously, as you go through that entire exercise, there's the tax advantages that come along with it. And so, there's going to be a really short window of opportunity here, 6 to maybe 12 months, where lenders are going to be looking to really get these assets off their balance sheet and or get them to performing again. And part of that equation is discounting some of those loans to an operator like ourselves to step in. And so, investors that are wanting to take advantage of this distressed market, there's a short window of opportunity and you need to act quickly. You've got to find an operator that you can get behind and trust and act quickly, because if you sit back watching and waiting for the right opportunity, number one, lenders aren't bringing new investors opportunities. Okay, some new investor that's deciding they're wanting to get into real estate today, they're not going to have a relationship with the lender that's going to bring them a book of business. If they've gotten in contact with the lender and said, hey, I want to see your balance sheet of what you've got, that lender has already given the deals that they feel confident about to their trusted borrowers. And if they still have something on their balance sheet, it's something that you probably don't want to touch. And so you want to get with an operator that has experience, that has those relationships, in order to get those deals that are in the best position to really take advantage of this distressed market right now and flourish over the next 36 months, like what we saw coming out of 07, 08. If you stepped in late 08, early 09, you really had an opportunity. By 2010, 2011, 2012, you were sitting in a really, really good position. And that's kind of what jump-started myself and my brother's career in real estate.
Okay, good. So Ty, somewhat related to that, but we get this question / concern quite a bit, with all those things that you mentioned. Is now the right time to invest in real estate? And related to that, we have a lot of investors that have done well in the equity markets. Equity markets are valued very, very high right now. Why would I take something that's performed well and move it into an asset class that has had some challenges over the past couple of years?
Yeah, I mean, so I'm not a big gambler, poker player. I like to know what my odds are, and I can play blackjack because I can count my odds. Once you start putting 4 and 5 card decks in a pile, then it gets a little bit tough. But I'm the same way with investing. What we've got right now in the equities market is many people are playing with house money at this point. So take a little bit of those chips off the table and reallocate is what I say. I don't say take everything out, but we're going to have a market correction. We're going to have a significant market correction. Last week we had a 1,000-point correction, and again on Monday, I believe, or there was 2 days in a row, business days in a row, that we had a 1,000-point correction, and that's the equivalent, of almost 4%, 5% in the market at where the market is today. And that's going to continue to move. We're going to see that correction continue. I think this conflict we have in the Middle East right now there's some uncertainty there. So we haven't seen the full correction yet, but we're going to have that. And so, the best thing that you can do is, even if you bought extremely low, go ahead and pull chips off the table. Recognize the top of the market that we're sitting at right now. Recognize that and reallocate a portion of your portfolio into something that you can take advantage of again on the upswing. Buy low in real estate right now, because right now real estate is at its most distressed time. And for a short window of time, it's going to stay there, and it's going to present some opportunities that I think are going to be once-in-a-lifetime opportunities. I'm already looking at some opportunities that I have never seen anything like this. And I've been doing real estate since 2004. And so, I'm already looking at some opportunities that are what I'm seeing a once-in-a-lifetime for me opportunity in real estate. And so don't set out this opportunity, this wave of opportunity, and wish you would have gotten in a year from now. Because at that point, it's already going to be, real estate's going to be on its rise back up, and you're going to be buying in midways up. Right now, the equities market is at the top and the real estate market's at the bottom. So it's time to sell here and buy here. And then watch that pendulum swing. And when you move your money properly, when you move a little bit of those chips off the table in the equity market, put it in real estate, you really have that compounding effect of buying at the complete bottom of real estate and taking advantage of that, that 3 to 5 year massive capital growth that comes with physical real assets. And yeah, there's a liquidity factor there. You've got to be willing to commit to that investment for the long term, 3, 5, 7, 10 years sometimes. But what you give up with liquidity, you gain in really having those 4 key criteria to success in investing. And one of the biggest one is the tax advantages, but then the growth power of having a physical, tangible asset that you've bought at the bottom of the trough and ready to ride it to the top.
Well, good. Well, we do have some investors that are bullish on real estate. They like real estate, and their next decision is, who do I use? And there's a lot of different operators out in the marketplace. Ty, how do investors know the good ones from the bad ones?
Well, I get oftentimes, in fact, 3 calls yesterday. I got, have you ever lost money, or have you ever had a failed investment? And any operator that tells you no is either 1, lying, or 2, they don't have enough experience in the business. So I think what you want to start with is experience, that right there. I've done approaching 1,250 real estate deals. And so in that number of deals, we've had some massive wins, and we've had a few losses. But we do a couple of things. Number one is, I like using a fund because it creates diversity for an investor. And so, where you may have a operator that puts a single asset in each investment, so investors come in for a single asset. If that asset fails or something happens, something catastrophic happens there, you've got single asset risk. Whereas in a fund, I've had a fund. In fact, I've got a fund open right now that lost a multifamily asset. It was an asset that was a really good asset. It was a smaller multifamily asset, but it was a really good asset in what was a good location when we purchased it. But with all the border issues that were going on with previous administrations, it ended up being about a mile away from a shelter that was taking on illegal immigrants. And that shelter then, after about a week, was pushing people out onto the streets, just to keep capacity. Well, there was a vacant lot next to this multifamily property, and ultimately that's where the undocumented immigrants started moving to, and they created a homeless encampment there, and it became a massive problem for this specific asset. But being that this asset was in a fund, we walked away from that asset because we were starting to put good money at bad. Walked away from it, and the fund still has double-digit upside to it because of how we've structured it. And so what I would say is, number one, you've got to look for experience. Number two, though, is looking for a clear defined business plan. Somebody who has not only goals, but they have a pathway of how they get there with each specific investment, and has multiple exits. There's not just, hey, we're buying this asset and this is the only thing that we're going to do, and if we can't accomplish this, we're going to fail. One of my very first failures ended up in a success, because it was really early on in my career in real estate, and I had a single exit model, and the market shifted, and that exit model was either not going to work or we had to change. And I implemented some changes, and that's when I started implementing a policy internally with our investments that we've got to have multiple exit strategies going into any scenario. And it was able to take a deal that, if we would have left it with the original exit strategy, was going to be for sure failure. We changed the exit strategy. We were able to recapitalize and created a huge success that turned into a moderate double-digit return on that investment. And so, having a clear business plan would be the second thing. The third thing is, getting behind somebody who not only you trust, but they communicate clearly to you. So many people tell you what you want to hear, but a good operator isn't going to tell you what you want to hear. They're going to tell you the totality of what's going on. You may not want to hear it. It may be bad news, but they're going to say, in our circumstances, we go and I will often say, hey, here's what's going on. Here's the issue that we have, but here's the 2, 3, 4 options that we have to overcome this obstacle, whatever that obstacle may be. And then the next thing that I look for is that, I want alignment. And with alignment for an operator, oftentimes that comes with skin in the game. Sure, you can go out and find an operator that's willing to pay a extremely high preferred return, take a really low promote, and charge no fees. And they're typically an operator that's just getting in the game and they have little experience and they don't have their own capital to put in the deal. However, with our circumstance, we got started with really little to no money. We bootstrapped it together, had a small loan from our dad and a small inheritance from our granddad. My brother and I did. And we built that over a 7-year period. We built our own portfolio using that little money of our family, and we grew that. Once we grew that, then we started getting the interest of investors to come in. So ever since then, we have put our own money in every single fund that we do. So we invest alongside the investors. We have true skin in the game. Okay, and then so we're not only making money on our money that we put in the deal alongside the investors. Now we're also aligned as an operator, because now I'm thinking as an operator, what's the best for this deal? But I'm also thinking as an investor as well. Hey, how do I want my money treated in this specific scenario right now? And so I think that is the biggest key to alignment, is having that skin in the game. And then the last thing that I look for, and specifically with us, is an operator that has every component of the business that they can do themselves or manage. And what I mean by that is, this industry can chew you up and eat you out alive. Whether it's construction, whether it's property management, whether it's acquisitions, whether it's dispositions, or dealing with the lenders. We've been involved in every aspect of that. Got started doing our own deals, doing the construction on our own deals. So I've been in construction for as long as I've been in investing in managing capital. I've been in construction for 22 years now. I can build a new property ground up. I can take an existing property and rip the roof off, put a new roof on, do all the floor. I can do everything in between. So when I walk on a property, I know when a subcontractor, or if in some circumstances, if we hire an outside contractor, I know when we're getting taken advantage of. Or better yet, if it's in the right markets where we have our labor force and we have our materials connections, we can beat any other contractor out there from a price perspective, and we know what we're doing. And when we have in another market where we're going and using a contractor, we can be very effective and very efficient because we know what we're doing as far as the construction. And then property management, we've managed our own properties, we manage third-party properties for other operators. And so there's an aspect to that is effectiveness and efficiency built into one manager that you're working with as far as placing capital with. And so those are really the 5 factors that I would look for in an operator on when you're placing capital and who to place it with.
Okay, that's good, Ty. Kind of coming near the end here, one of the other pieces of feedback that we get is a lot of our investors or prospective investors work with financial advisors currently. And I get this question a lot: why hasn't my financial advisor not only talked to me about alternatives as a broad umbrella, but real estate specifically as an asset class that I should be considering?
Yeah, I mean, I think that's a really good question. In fact, I had a call yesterday with one of our existing investors who wanted to bring his financial advisor into conversation. I'm meeting with another one of our investors on Thursday that has a couple $1 million with us and his financial advisor. I think there's a number of factors that go into that. Number one, I'm going to call it, I guess, complacency. Many financial advisors, they have a book of investments and opportunities that they typically work with, and they have built a plan around, or their firm has built a plan around, and so they have a little bit more of a narrow focus. And what a private investment brings to a financial advisor is another investment that they have to figure out how to run the due diligence on and how to do the underwriting for their client on. And what I find is that many financial advisors don't have experience in the private space. And so they don't know how to underwrite that deal. They know how to look at a stock and say, hey, this is trading at 2 or 3 times book value. There's some good opportunity here. Or, hey, this is trading at 4 or 5 times book value and it's way overpriced right now. And there's a number of factors that they know how to underwrite that. But with private investments, they oftentimes it's new to them. They have to compare apples to oranges. They're looking at stocks, bonds, mutual funds over here. They're looking at privates over here, and they don't know how to compare the two. You've got liquidity, you've got illiquidity, you've got a short-term plan and a long-term plan. You've got a long-term focus here. You've got higher growth potential here. Oftentimes, you've got tax advantages here, no tax advantages over here. And so there's a number of factors that go into that. And then the next thing is, let's call it what it is. Oftentimes, financial advisors look at it as they're losing that business. And so they're charging an asset management fee on their portfolio. And let's say you've got a $5 million portfolio with an asset manager and you're looking at moving 20% of that into private and alternatives or real estate. So they're losing $1 million in AUM. And oftentimes they look at that as loss of money. There is, with our situation, we compensate the financial advisor as if that book of business is still under their AUM. And so there's an opportunity there. And so I think that's why many financial advisors have found beneficial to work with us. We've got a number of them that have worked with us, and it's been a great situation. In fact, we've got one that I was on the phone with him and a couple of his clients yesterday. He's allocated about $22 million with us. And has a number of clients that he allocates through with us. And so, I think it just boils down to what the financial advisor's experience is, what their ability to underwrite a deal is, and then selfishness. Are they losing a AUM and the form of a fee? And so, I think you've got to take all that into consideration as well as an investor. Does your financial advisor really have what's in the best interest for you? Because, you could go, put your capital in a REIT and you're going to miss out on 3 of those 4 keys that I talk about. You're not buying at a discount. You're going to get some appreciation. You may get a little cash flow, and you're definitely not getting any tax advantages with a REIT. And so, or you've got the BlackRock REIT right now that has turned off distributions and redemptions. And so, that's no different. It now it becomes a less desirable investment that sounds like it's real estate, but it's not really, that now all of a sudden has the same illiquidity factors as if you would have gone into private investment real estate anyways. So I think those are the factors that you need to pay attention to as an investor looking to place capital, and specifically if you're working with financial advisor as well.
Yeah, my background on the advisory side started before the dot-com bubble. So, what I have found in many cases is advisors may not know that their clients already invest in real estate. It just may be off to the side. So for any of our financial advisors that are listening, it's good to be able to understand that so you can really provide that holistic guidance to your clients as well, because there are a lot that may use that as an investment vehicle. You just may not know about it. So we hear that quite a bit in the industry as well.
Yeah, you bring up a really good point there. If you looked at our well over 750 investors at this point, there's probably 35-40% of them who currently have or have had their own real estate portfolio. They end up partnering with us, one, because they found that having their own real estate portfolio was a second full-time job for them that they didn't want to get involved in, or 2, it's not necessarily a full-time job. They hire a third-party property manager, but that third-party property manager manages to mismanage everything that they manage for them. or 3, they're approaching retirement. They don't want to go into retirement and have to deal with all of that, and so they're looking to place capital elsewhere. And then many of them just sell their portfolio and invest with us. Some of them have kept their portfolio and invested additionally with us and slowly offloading their portfolio. But you've kind of got everything in between. And so, yeah, as you mentioned, many financial advisors don't necessarily realize that their client already is involved in real estate in some capacity.
Yeah. So Ty, I want to make sure we put in a plug for our website and a great vehicle to contact us. It's lassitercapital.com, and if you go there, you can click right on the button at the top to set up some time to schedule a meeting with Ty, myself, or Boone. As we kind of wrap up here, Ty, are there any final thoughts you would provide as why now is a good time to invest? We talked about the market as a whole. We talked about some of the benefits of really doing proper due diligence on operators in the marketplace, but any kind of final thoughts you would highlight for our listeners thinking about the next couple of months and the opportunities in the real estate market?
Yeah, so as you mentioned, that's lassitercapital.com, lassitercapital.com. But yeah, I mean, as we've always heard in real estate, you don't wait to buy real estate, you buy real estate and wait. But now is the perfect time for that. Oftentimes if you jumped into the market in 2021, 2020, early 2022 or late 2020, anytime in between that time frame, you literally had to buy real estate and wait, and you're going to be waiting for 7 to 10 years there. Okay. But right now we've got that really short window of opportunity that happens every 20 years or so. And it so happens that this one happening this time, I am seeing opportunities that we've never seen before in real estate corrections. There's some nuances to this one that we haven't seen before. And sure, history repeats itself every 10 to 20 years. The real estate market resets. But when you by happenstance time the market, I hate timing the market, okay? But when you by happenstance time the market, you never want your exit to be predicated on timing the market. You want to have multiple exits so that you don't have to worry about that. But when you have the opportunity on the buy side to time the market at the bottom of the market, now all of a sudden you don't have to wait as long in real estate. So you can buy and wait a little bit and see phenomenal gains, or you can wait long term and see astronomical gains. And so, I think that the key thing here is we're sitting at the bottom of the market right now. So right now is the keen, opportune time to be investing in real estate. And then just remember, you buy real estate and wait. You got to have a good plan in place while you're waiting. And oftentimes what I find, and this is what I find with many of our investors, significant 35-40% of our investors don't have that patience to wait. And I've had some that they've gotten into real estate themselves, and they, it didn't go the way they wanted to, and they just dumped, and they didn't make any money from it. But those are the ones that are trying to time everything, and they let the headlines of the media and the headlines of Wall Street dictate their decision making. That is what is so important about partnering with an operator who has experience. Number one, know that real estate is a long game. Number two, once you're okay with number one and you're ready to commit capital with an illiquidity component to it, then make that commitment, understanding that it's illiquid for a time period. But number three, you do that with a partner who has patience, who has experienced the vast, wide range of scenarios that can play out in the market, and they have a plan, but most importantly, they've experienced and shown patience. That's the operator that you want to partner with, because when you see a headline in the media and all of a sudden you want to pull the cable and exit something, that operator has the experience to know now is not the right time. We're in the wait period, and we're going to wait this out for the right opportunity at the exit. And so, I think that's what we need to see right now is, number one, right now is the right time. Okay. And if you're not doing it yesterday, today is when you need to do it. And we're at the bottom of the market. And so it's time to place that capital there and then wait and see where it goes, and do that alongside a seasoned, experienced operator who has skin in the game alongside you and knows every aspect of the business.
Really good information. Thank you, Ty.
Absolutely. We'll check y'all next time. Follow us on YouTube, Lassiter Capital, Instagram, Facebook. You can follow me personally at Ty Lassiter. That's TIE, like a necktie, LASATER, or Lassiter Capital. We're on X as well, across all the social media platforms. If you've got questions, comment below wherever you're seeing this right now. Look forward to hearing from you, answering any questions that you might have, and we'll see you next time on episode 14 of The Growth Factor.